My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to help you make some money. My job is not just to entertain, but to educate, teach, try to explain this stuff. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You have to hope for the best, but prepare for the worst. Yep, talking about the coronavirus, which the Centers for Disease Control now tells us cannot be contained. And that's really why the Dow plunged another 879 points today. S&P plummeted 3.03%. And the Nasdaq nosedived 2.77% on top of yesterday's hideous losses. The Dow's now lost 1,911 points in a row. That's a decline of 6.6%. 2 days. Now, you don't need me to tell you that this is serious stuff, especially if the director of the National Center for Immunization and Respiratory Diseases told us this afternoon to now expect, and I'm using her terms, significant disruption in our lives. Instantly, that rather disconcerting position became the conventional wisdom. That is the chief reason why we sold off so hard, particularly in the afternoon. Of course, it is always a little more complicated than that, right? Now, our stock market is following the much larger fixed income market, where bond yields are currently hitting record lows. All sorts of maturities. When interest rates collapsed today, the benchmark 10-year Treasury now yields just 1.35%. Stocks got crushed. The bond market is screaming that this pandemic will cause a dramatic decline in economic activity both here and around the world. And when the bond market speaks, the stock market takes that word as gospel. If you want to prepare for the virus, I want you to go to the CDC's website, cdc.gov. I'm not a doctor. I don't even play one on TV. But what I can do is help you prepare your portfolio for the coronavirus-induced economic dislocation, which is clearly occurring. Now, after two vicious down days, we find ourselves at an important crossroads. As Warren Buffett told Becky Quick, it has always been a great time to buy American stocks, and sometimes when they're on sale, it's an even better time to pull the trigger. So is this one of those moments? Let me tell you how I approach these situations, because it's not cut and dried. First, as I have advised you for weeks now, I have said I want you to have a ton of cash. How much is a ton? Depends on you. For my charitable trust, which you can follow by joining the ActionAlertsPlus.com club, 20% of our portfolio is now in cash. That's abnormally high. We were still selling stock even this morning, raising cash. I thought we'd be down today, so I spent all morning on Twitter at 3:30 a.m. Whatever. Realmoney.com, squawk on the street, even when the averages were looking up, telling you no, no, no. Now, when the market briefly did rally this morning, even as the bond yields were already tumbling to record lows, signaling a worldwide slowdown, you know what we did? Yep, we used even that strength to sell. Have to. See, this morning was a sucker's rally. And you knew that because the bond market, by having interest rates go lower, told you it was a sucker's rally. Yeah, the trust actually sold a stock I like. That's the kind of stuff we're doing now. Activision Blizzard, huge video game company. Even though I figured Activision would be pretty much immune to the virus, doesn't matter. Wanted to sell another favorite, Home Depot. Home Depot, they reported a blowout quarter. I believe the pandemic will keep people from shopping, though, and that stock, which was up really huge, ended up giving up the gains. Yeah, should have unloaded it, I guess, but I don't want to take too short-term review. My restrictions wouldn't let me ring the register, but what happens if Larry Kudlow, the president's chief economic advisor, my former co-host at CNBC, is correct when he tells us to be a little more optimistic and a little less hysterical? I've known Larry for a long time. He's been right a lot. In that case, you could do a lot worse than owning a stock at Home Depot. We know they're doing great. We know that as of this morning. And we know that they thrive in a low-interest rate environment, although this is how hard things have gotten people. Toll Brothers, the high-end home builder, reported an extremely disappointing quarter this very evening. Metaphorical, isn't it? Unfortunately, we didn't see too many buying opportunities today. I tried, was looking all day, just kept looking at the screen, sell some CVS. Thought, hey, maybe CVS should buy that one. That could be good, right? But you know what? The stock fell hard thanks to the sudden ascent of Bernie Sanders. Because CVS had purchased Aetna, a health insurance provider, and Bernie wants to make private insurance obsolete. However, even if this coronavirus causes a recession that lets him win the White House in a landslide, another theory going behind people selling heads is he won't have the votes in Congress to pass a single-payer health care plan. All right, so why not be more aggressive after this huge decline? Isn't that what we're supposed to do? Isn't that what Buffett's telling us? Well, let's parse it a little. First, the rest of the world is slowing dramatically as the virus goes global. I don't think that's in all the stocks. It's not in the numbers. Second, the transports. Boy, do they ever flash red. They're the most important bellwether group, and they are getting annihilated here. Trucking down 9% year over year. Later, we're going to hear from WEX. That's a company that's deeply involved in helping truckers save money on fuel. Got to get a better read on this most economically sensitive industry out there. Fortunately, they're diversifying away from it. Remember, it's not the disease itself that's causing this carnage. It's not even, don't let people tell you it's the fear that's causing it. No, it's the fact that's causing it. The fact that the disease is disrupting commerce. It's slamming the brakes on the economy. It's not the only thing you have to fear is fear itself. That's wrong. The only thing you have to fear is the facts, and the facts aren't good. Give another example, MasterCard. Another company we happen to have on the show tonight. MasterCard stock has been a phenomenal long-term winner, one of the best in the entire market, one of the top, really, for the last 10 years, probably one of the best there is. But last night, the company cut its revenue forecast because of, yes, the coronavirus. I'm confident that a year from now, we could look back and say this was one-off. But that didn't stop people from dumping the stock. No one says, oh, wow, I don't have to worry about the coronavirus. That's not how it works. MasterCard's book of business is pretty representative of the global economy, not just South Korea and Italy, where the outbreak's really taken off. I bring this up because if it can happen to MasterCard, it can happen to anybody in travel and leisure and retail. You just don't shop much when you're under quarantine or worried that you might catch a potentially lethal illness. Commerce will go on. It always does, but it's going to be at a slower rate than we were expecting, certainly that the companies were expecting. That's what matters. Given that the averages hit record levels last week and the froth was as thick as I've seen it in ages, I think the slowdown still isn't in these stocks. And that's why I continue to recommend this heavy cash position. I'll give you a good example, Macy's, okay? The department store chain actually reported a good quarter, better than expected. But what did it have to do? It had to address the coronavirus. And that was all she wrote. Stock reversed, finished down the day, down 5.5%. I've already been adamant that you should avoid the travel and leisure stocks. I've told you, I can't dump on the cruise lines anymore. I just feel awful doing it. But, geez, that's in the never too late category. Retailers, restaurants, they could be off limits, too, if the CDC advises that people should go into lockdown mode, which is what I thought they were doing when they talked about disruption of our lives. I don't need to scare you with that list again. Obviously, speculative stocks have had their day in the sun for now. The air's coming out of those balloons. Get out of them. And oil and gas, sell. Environmental issues aside, you don't want to own energy into a slowdown. When oil breaks through 50, and I think it will, I think it'll dawn on people that it's not just environmental concerns that are getting people out of those stocks. Who doesn't miss the numbers in this kind of situation? Who can actually count them? All right, the utilities, many of which have run so much, some have more upside. I still like letter D, Dominion. I like Con Ed, too cheap. I can't emphasize gold enough. I do it every single night. It's probably boring the heck out of you. You want to be creative. If people start staying home in large numbers, I think Netflix is a big winner for obvious reasons. I recommend Amazon, too, if I weren't so concerned that delivery could be a problem. I debated talking about Disney. We got a new CEO that coming. Iger's going to be exec chairman through 2021, but a new CEO tonight. I was thinking Disney Plus, but you got those theme parks. No, not for me. Alphabet and Facebook, they can go lower, but you know what? They have strong businesses. They're not in China. Oh, boy, can you believe how lucky those guys are? They probably do well in this environment. All right, so what's really doing well? You know, the trio. I still think that Zoom video, because you can be at your home, Moderna, because they have the vaccine that even Dr. Fauci talked about, and Gilead, because they've got the acute therapeutics, which means they've got antivirals. Those are my three musketeers. They're still buys, although the first two need to come a bit because I wouldn't put new money in them after these runs. Finally, cash. It's your pal. It's your king. As you roll through this moment until the market at least becomes more oversold. We are only at -4. After this kind of market, this kind of news, I don't know, how about -5, 6, 7, 8? I feel better. When will most tech and industrial stocks that get so low that they reflect the global economy's newfound weakness? And I'm saying buy? Depends. If the virus strikes here in a big way, then I think we'll end up having a lot more downside. Any sector that relies on consumers actually going out and spending money will be in very big trouble. But if it doesn't come here in large numbers, then the downside will be more limited. We'll know more. Don't worry about it. We'll take our time. Now you've been prepared for the worst. I think hoping for the best is premature. Bottom line, I want to be more aggressive. I do. I want to believe that Moderna's vaccine works, that Gilead's antivirals has an impact, that Zoom's the way to work at home, and that I will have more stocks to recommend as the market goes down. But right now, I'd feel a lot more comfortable if there were even more pain in the market to reflect the true ugliness of this situation. Not now. Not yet. Will in Hawaii. Will.
Hi, thanks for taking my call.
Of course.
I want to diversify and get some health care. The healthcare insurance stocks like United Health, again, have negative political pressures. For news money going in now, do you feel rather a drug company like Bristol-Myers is better postured, better here, or does it have a higher, because it does have a higher PE and lower EPS than Johnson & Johnson?
No, I like Bristol-Myers very much. It's got a 3% yield. But why is Bristol-Myers going down right here? Because of Bernie Sanders, because people feel that Bernie Sanders has put a target on the back of all these drug companies. So Bristol-Myers probably goes to 58, 59 before my travel trust would say, you know what, got to buy more. How about Jim in Virginia? Jim.
Hey, Jim. Pleasure to talk to you.
Same.
I've been listening to you for quite a while, and I've learned a lot. I've learned to keep some money on the side.
Yes.
It's a lot easier saving money than watching the market go down when my money's in the market. So I'm trying to not be a pig so much. And last week, NVIDIA, which was one of my stocks, it reached its all-time high, so I took a lot of money off the table.
Yes.
I wouldn't have done that if you hadn't advised that in your books and on TV.
Right.
And then my real question right now is, and I think I know the answer,
okay,
but I want to hear from you. Do you think we reached the bottom yet?
No, you made a great sale. Let's not press our luck. That was brilliant. You got horse sense. That's all I want from people. We sold NVIDIA a lot. Some of it, we felt like idiots. That's often the best kind of sale, the one that feels idiot, and then it's real smart. Today was excruciating. So was yesterday. Hey, it's probably not over. I want you to prepare for the worst. Get tough. We'll make money tonight. After a decade at the company, MasterCard's Ajay Banga is stepping down. Ajay, we love him. He's made a ton of money for people. I'm talking to the bankable leader and successor about what's next. Then two charts, two big worries. I'm tackling the technicals, telling you why they scare the heck out of me. And Salesforce just reported after the close and announced that Keith Block is stepping down. Holy cow. Ajay Banga retiring, Bob Iger, and now Mark Benioff's partner, Keith Block. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.